All right, how's it going, friends and family? My name is Amos, and today we're going to be talking about a growth stock that is profitable. And I'm talking about a business that has revenue growth of 23% year over year, more cash on the books than they have loans, and their free cash flow is growing at a pace of 54% year over year. The business in question is the Trade Desk. Year to date, they're down 61.5%, and they're going on a massive sell-off, which I'm thinking, dude, is this a buying opportunity? Well, in this video, we're going to be investigating the Trade Desk, and I'm going to be calculating an intrinsic valuation or their inherent worth of what their stock price should be. And towards the end of the video, I'll be telling you my game plan. So if that sounds good, let's go ahead and get into it. So their business overview. The Trade Desk helps companies place ads all over the internet and into streaming services. So if that one sentence wasn't enough for you, let's dive a little deeper. What exactly is their business model? So the Trade Desk, ticker symbol TTD, is a demand-side platform, otherwise known as a DSP. Think of it as like a sophisticated software platform for advertisers. And its core function is to allow those advertisers and their agencies to buy ad space across the open internet. And you're not just willy-nilly buying ads and praying that it works out. You're buying them in a data-driven way so that it's catered towards the correct audience and customers. So the paying customers of the Trade Desk include the marketing teams from big brands like Disney or Procter & Gamble, but also advertising agencies, as I just alluded to. But something that you have to understand about the Trade Desk is that they do not offer and implement advertisements in walled gardens like Google's YouTube or Meta's Instagram, and etc. So when you think about the Mag 7, I feel like a lot of consumers, especially here in the US, that's where we spend our time using Microsoft products, using Google's products, using Amazon's products, and etc. However, instead, the Trade Desk, they place ads on the open internet. Why do I keep saying that phrase, the open internet? That refers to everything outside of the realm of the Mag 7. So think about all of the various and different websites, apps, and streaming services that are not owned by the walled gardens. And by the way, when we think about the walled gardens, like Google's ecosystem of YouTube, apparently with their data analytics, it's less transparent to the customers. So you could buy like a $100,000 advertising campaign to be placed all over YouTube, and you won't exactly see the full transparent breakdown like you would with the Trade Desk. So when you think about the Trade Desk and where they place their ads, this would include news sites like the New York Times, CNN, the Wall Street Journal, streaming services like Hulu, Peacock, Roku, and millions of other websites and apps. So their business model, I think, is pretty cognizant and is pretty sound. But how exactly do they make revenue? I think it's kind of simple, but I'll explain it just in case. So companies like Nike or McDonald's, they will spend advertising budget money through the Trade Desk's platform that uses AI, data, and numbers to place the ads in the correct media outlets. And for that service, they usually take a 20% fee, also known as the take rate. That's been their historical rate. And I think investors are going to start pressuring them to increase it to like 25%, but that's for a conversation of its own. And the media outlet takes the other 80% cut. So the specific website, the app, the TV broadcast network, Pandora radio station, whatever, they take the other 80%, and the Trade Desk takes 20%. So think of Trade Desk as like the middleman, the broker. But I think it's worth calling out that when you think about these big brands like Disney, Nike, Home Depot, and whatnot, they're not just going to partner with the Trade Desk. They also want to maximize the value of their advertisements, right? So they're going to work with Amazon, they're going to work with Google, they're going to work with everybody in the space, not just specifically Trade Desk. And so I think that raises the natural question of like, why the heck would an advertiser pay a fee to a platform like the Trade Desk instead of going directly to the publishers, like to the Wall Street Journal, and broker a deal between the two? Well, friends and family, check this out. Based on my research, this is where the Trade Desk's value proposition comes in. Because number one, what they offer is efficiency and scale. When you think about it, the open internet, millions of different apps and websites. It's big, it's huge, and it's fragmented. It's not consolidated, and there's no standardized way in order to come up with a plan and a contract on how you want your advertisements to be placed in front of the users, right? So it's impossible for a big brand to just negotiate and buy ad space from thousands of individual websites, apps, and streaming services. So that's where the trade desk, as that middleman, that broker, comes into play, because they connect the brands with the entire internet ecosystem. And apparently, based on my research, the Trade Desk software and platform is super easy to use, and it's really insightful with the numbers and data that they present to their paying customers. And then number two, something really cool about the Trade Desk is that they allow their paying customers and the advertisers to use their own customer data and to integrate it into the Trade Desk. That way, you can target the right audience across the open internet, as we just talked about. So if you specifically want your ads to only play in front of middle-aged men with receding hairlines because you're trying to sell a service of hair transplants in Turkey, the Trade Desk will get that done. Jokes aside, thinking about Procter & Gamble's diaper line, Pampers, they're going to target ads for the relevant demographic of young families with small kids. Does that make sense? And the Trade Desk will make that happen. They're not going to place a Procter & Gamble diaper advertisement in the eyes of like an 80-year-old. It wouldn't be relevant to that customer. And then number three, this is where they dominate. This is where the walled gardens are not really tapping into, because the Trade Desk, they pretty much have a monopoly when it comes to the connected TV space. So when you think about Roku, Disney, Paramount, Peacock, as we just talked about, they work with the Trade Desk instead of Google to place ads on their streaming services. But it's not all rainbows and sunshine, because as you can see on your screen right now, in the past 1 year, they fell off a cliff, right? If we zoom back and we look at the past 5 years, they're up by 7.8%, and they reached a high of about $140 a share. But to be $45, what the heck is going on? Let's go ahead and talk about the downsides of the Trade Desk. Well, number one, the advertising budgets and spending, it tends to be really cyclical. There are highs and lows in this industry. It's not like a company is going to be consistently and reliably spending the exact same amount of campaign money for whatever they're trying to sell every single quarter. And unfortunately, when a company is struggling, one of the first places that they cut money is through their marketing and advertising teams. Especially during economic downturns, the companies are not going to be spending pound for pound the exact same amount of money into their marketing as they did in the past. So seasonality on a micro level, when I think about YouTube itself, my videos on YouTube tend to make about an extra $1 per 1,000 views in the autumn. And that's because advertisement spending in the fall tends to go up, because there's a lot of major holidays where customers are spending money, like Black Friday, Cyber Monday, Thanksgiving, Halloween, Christmas, the list goes on and on. Whereas on the other side of the spectrum, in the winter, in the months of January, February, and March, I tend to make less money per 1,000 views. Sometimes it's like $2 to $3 less per 1,000 views per video that I upload. And I think it makes sense, because the consumers are less likely to spend money during those months because they just went gung-ho during the previous holiday season. So the first downside to the Trade Desk is that it's in a very cyclical industry. And then number two, I think this is the bigger reason, and it's more important. Mag 7, as of right now, at the time of making this video, they're rolling out and they're ramping up their own DSPs. Demand-side platforms, otherwise known as DSPs, that's what the Trade Desk is, especially Amazon DSP, that is going to eventually steal contracts from the Trade Desk's partners, mainly Netflix. And because of that, the market was like, dude, we're going to sell out of you. Your future is going to be ugly, hairy, and smelly. But I think it makes sense, because when you think about the digital advertising space, it's a zero-sum game. If someone's winning, then someone has to be losing, meaning there's only a finite number of ad money that they're all fighting for. If Apple, for instance, has about $50 million to spend on their ad budget for the new iPhone 17, then the Trade Desk needs to try and claim as much of it as they can. However, because Netflix is now going to do business with Amazon's demand side platform, that is objectively going to eat into the trade desk's potential revenue. So now that we understand the basics of the trade desk and why they're selling off, between you and me, here's my thoughts on what's happening. I think it's going to be a splash in the bucket in terms of their loss revenue. Because when you think about the overall picture and the entire advertising space, think about all of the new apps that are being developed every single day that may or may not go viral. Think about all of the websites that are popping up left and right every single week. They still have the opportunity to do business with the trade desk. Now I get it. Netflix is already established. There's a huge customer base, potential revenue from ads playing on their subscription plan. Yes, that's going to be big, but not as big and as catastrophic as Wall Street is painting it out to be. To me, I think what's going to be a bigger stab is that Walmart is now going to share its customer data with the other ad platforms instead of exclusively giving it to the trade desk. This means that the trade desk is going to lose its Walmart data competitive advantage that they used to offer to other advertisers like, hey, this is why you should pay us more because we can offer you this gold, this wealth of knowledge of the Walmart customer base. But now they can't do that anymore. They can't upsell their services with their potential advertisers. And I think that's going to be a bigger hit to the revenue rather than Netflix working with Amazon. Because when you think about it, Walmart, dude, they're responsible for about 10% of all retail spending here in the US. It's super influential, and that's why if you're Procter & Gamble, if you are Kimberly-Clark, if you are Colgate-Palmolive, you want to know that Walmart data. And the fact that it's no longer exclusive on the trade desk's platform, yeah, it's gonna be big. However, friends and family, despite the sell-off, what you have to understand is that the total addressable market size for digital advertising as of right now is $700 billion. And that's why, friends and family, Google prints cash, because that's their main bread and butter and business of how they generate so much revenue. Because human psychology tells us that advertisements are effective in promoting or trying to sell your product or service. And it's only gonna get bigger because as of right now, the trade desk, they currently hold and penetrate less than 2% of the digital advertising market, despite competition from the Mag 7 and Amazon's DSP and Walmart Labs advertising line of business and Google and everything else. So when you think about it, less than 2% and they're crushing it. And based on this market research that I saw from the Morning Star, they're projecting that despite all of this market share eroding away from them, the trade desk should still grow their revenue 15% year over year through the year 2034. And that's on the conservative and safe side of the equation, 15% at a minimum. So I'm a number and data's kind of guy. Before I show you my calculation for their inherent worth per share, like how much they should be trading for, just take a look at some of their financial statements. Right now, we're taking a look at the income statement. Look at the growth of their revenue year over year. It's going from $113 million in 2015 to what it is in the past 1 year of $2.6 billion. Friends and family, look at the percentage change. Sometimes it goes up by 54%, and as of the past 12 months, as I alluded to in the introduction of this video, 23%. And in the pandemic, they were still able to grow their revenue by 26.4%. This is pretty crazy. You scroll down, and as I said, they are profitable. Per share outstanding, they generate 83 cents of profit. And if we swipe on over to their balance sheet and you take a look at the cash and cash equivalents, they have $1.6 billion of cash on hand, which is a growth of 12% from the year prior. And if we scroll on down and take a look at their total debt, how much loans and how leveraged they are when you take into account the short-term obligations and the long-term stuff, they have $343 million of loans. So after you pay off all of the loans with the cash that they have on the books, they have $1.3 billion of cash left over. Cash heavy, beautiful balance sheet. And it gets better because when we take a look at their cash flow statement, take a look at this. Their free cash flow right now is $755 million. That is absolutely bonkers. A growth of 54% year over year. Take a look at it visually depicted. Since 2019, dude, this company is just printing cash. This is beautiful. So despite the sell-off, I'm like, dude, their numbers and data, oh, wow. But all that to say, if we look at their discounted cash flow, growing at a rate of 15% year over year, even though right now it's 54%, we're going with what the analysts are projecting, then on paper right now, the trade desk should be valued at $51.87. I think at the time of making this video, they're somewhere around 45 bucks. So they're kind of near their intrinsic valuation according to how much cash they print from their operations. Something that I do want to emphasize is that their trading multiple right now based on what they are producing, their earnings per share is 54. So you take their price, $45, and you divide it by 83 cents of profits per share, otherwise known as the bottom line per share. That spits out 54. So they trade for a pretty premium. Okay, their PE to me, I think is still very, very high. However, their forward trading multiple, 23.8, a little more digestible. However, something to take into account is when we think about their historical PE ratio, their price to earnings, in the past 10 years, it sits at around 116. And if we just think about the past 3 years, then it's 74.1. Right now, it's hovering around 50. So their valuation in comparison to their own past is on the lower end. However, their growth story, as you saw by their revenue growth year over year, the percentage change, it is slowing down. And in a very bearish estimate, the growth rate should be 15% year over year. So taking that into account, if I were to project and forecast a price for the trade desk based on their earnings, if they close out 2025 with $1.55 as their projected earnings per share, by the way, this is the low estimate by the analysts, and their PE going down to a 40 from the 55 that it is right now, then they should realistically be $62 a share. However, if they close out the year at about a 50 PE, which is what they are right now, and they're able to bolster and increase their earnings per share, then they should be $77.50. And if they continue to improve their margins and become a crazy cash printing machine like they have been for the past 10 years, and they grow their earnings per share by 25% year over year, and you might be like, dude, that's a little too aggressive, but let's jump on back over to their financials. And right now we're on the income statement. If we scroll on down and take a look at their earnings per share improving year over year, 200% from 2022 to 2023, and then 116% 2023 to 2024, and right now 62%. So for me to project a 25% improvement year over year, I think that's realistic and even conservative. So if we jump on down to 2028 and they post $3.03 and their PE is going to be a 34, then they're going to be $102.93. Now, mind you, if something goes crazy and they're able to tap into more of the market share of the digital advertising space instead of just 2%, and they capture like, I don't know, 4% or 5% of all the potential revenue in that area, and they're able to increase their earnings per share to $3 in the next like 12 months, then they could realistically also be $103 a share if their PE, if Wall Street values them at a 34. This is a very high growth company that I still think is a little expensive, but as you can see, based on our numbers that we're plugging, very conservative ones, by the way, they're undervalued. However, according to their free cash flow, then they're almost at the right price. I mean, you get them at a $5 discount, but no matter how you look at it, the trade desk on paper is undervalued. I'm not going to say it's the bargain of the year, of the century, because that was United Health about 3 months ago. If you missed that boat when they were $240 a share or $250 a share or $260 a share, I feel for you. The trade desk right now, I think it presents an opportunity that I feel like is you're going to have to wait till the end, because right now we're going to be taking a look at the compounder chart. So in comparison to some of the other businesses that we evaluated on the YouTube channel in the past like 3 months or so, we're going to place the trade desk either on the left side, which means they're a certified compounder that I think will grow your money from $100 to $200 in an XYZ amount of years, or they're going to be placed into the Kager graveyard, meaning by investing into them, your rate of return, your ROI is going to be like, I don't know, 3%, 4% year over year, and it's not the wisest use of your capital. And in the middle is if I'm going to be unsure. Watchless, waitless. I don't know if I want to invest into them or if I just want to be on the sidelines. So as you can see, Google for me, I feel the most bullish about out of everyone that we looked at so far. So when it comes to the trade desk, they're going to be placed into the certified compounder category. I think their company history and the numbers that they're posting, I think it speaks volumes and it speaks for itself. I think this is a very high quality company that is, unfortunately, they're driving the ship right now into very murky and dirty water. We don't know how devastating of a blow the Netflix and Amazon partnership is going to be in terms of the ads, but also Walmart opening up the doors for their data to be available to all of the ad players. I think that's a huge blow as well. So, is this company going to go belly up? Are they going to go bankrupt? Are they doomed? Are they ugly? Objectively, I don't think so. So, this is a perfect time for me to segue into my game plan. I genuinely like what I saw with their numbers. So, in a best case scenario, I'm assuming that the trade desk, they should finish out the year or roughly in the next like 12 months, because right now it's September. I don't know if they can do this, pull it off in the next 3 months, but if we expand the timeline to 12 months, then I think they should be around $70 a share, which at their current price point of about 45 bucks, I think that's a pretty modest upside. And I think worst case scenario, they're gonna get swallowed up by a bigger fish like Walmart Labs or Amazon. They just don't wanna deal with them anymore, and they just want all of their data and information and customer base that they already have, existing customer base, they're gonna swallow them up and take them away from the game. I also think Salesforce could jump in because they are a serial acquisition company where they love to swallow up whoever is blowing up in the SaaS space. And I think it would be a good way for them to jump into the advertising line of business. And I say that as a former investor into Discover Finance who got acquired by Capital One. And I say that because I remember when Blizzard Games, Activision, they were acquired by Microsoft. So I think worst case scenario, they're going to get acquired for, I don't know, $80 a share by their competitors. Best case scenario, in the next 1 year, 70 bucks. In about 3 years, they should be roughly 102 bucks based on my math and calculation if everything goes according to plan. Now, if they poop their pants and things go south, obviously they can drop to like $20 a share. However, I don't see that happening. So me personally, I plan on buying the trade desk once I see them bouncing around and trading flat for a few days or so at whatever price they settle on, because they were going on a massive sell-off and I don't know if they're going to continue to free fall, right? You don't want to catch a falling knife. But based on what I'm seeing with the technical analysis and the indicators, I think 45, 44 seems to be their line of support. So I might jump in. I'm not saying I'm going to, I'm going to monitor them. Anyways, how do you feel about the trade desk? Are you invested into them? Do you feel bullish or bearish about them? Now I get it, they don't pay a dividend and this is a growth stock, but I'm the type of guy to wear multiple types of hats when it comes to investing. And I think a compounder, regardless if they pay a dividend or not, should be worthy of considering and thinking about, unless of course their numbers look terrible. But with the trade desk, I like what I see. Anyways, I would love to hear your opinion. With that said, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you very soon. Peace.